Let's start off China. Breaking news. It's just cut rates, interest rates, 5.6%, I think it is.
Yeah, I was looking at it on my phone on the way to the studio today. And
what does it mean?
Well, I mean, obviously this is it's quite unprecedented. I mean, it's the first time they've done it, I think, since July 2012, and this is obviously just another stimulus measure to try and boost growth across China. I mean, that's obviously going to be fantastic news for our commodity players, which have been under a huge amount of pressure in the last couple of weeks, and in fact for most of the year. I think if you look at it at the moment, we've got Kumba probably up about 7% at the moment, and that's as that news broke. I mean, I believe it was published on People's Bank of China website, and it's definitely it's good news. It's definitely good news for the markets, and I think good news for a China economy that had definitely started slowing.
I guess as we speak, the rand is strengthening.
Most probably.
Yeah. Let's move on to some company news we've seen today. Goldfields. Okay, not news, but I noticed for November. That's the best performing stock we've had. Why is that?
No, I think it's very dangerous to look at Goldfields perhaps in isolation, because these gold miners have been incredibly volatile.
Yeah.
And that's again, it's on the back of the commodity prices moving around. So I mean, I looked at it this morning. It was down 5%, and you're seeing enormous swings in the counters. Again, gold's just snapped the losing streak on the back of that Chinese announcement. But if you look at Goldfields compared to something like Anglo Gold or Harmony, it probably is one of the better cost producers. I mean, I know Nick Holland was saying yesterday that if he looks at the whole gold mining industry globally, their costs are probably sitting at around probably about $1,300 an ounce to produce, at least to mine the gold. And with the gold price sitting at sort of $1,200 an ounce, that makes it very, very difficult for these companies to make profits. Goldfields, he says, is their best estimate across all their different operations. It's sitting at about $1,100 an ounce, so they are at least still profitable. And I think that's why, if you compare them to the likes of Anglo Gold, Harmony, they probably are outperforming at this stage.
All right, it might not last long though. Let's talk about Nampak. They came out with numbers overnight, and they say they're going to sell the paper business. What do you think about that?
Yeah, I mean, that paper business, I mean, you understand why the guys are doing it. They sold it at about a 20% discount to its net asset value. So never nice to see them have to let go of an asset like that and obviously take the impairment. But I mean, the point they made was, they only had margins of about 2-3% on those assets anyway. So for them, it's far better. It's a far better move to obviously sell out of it and go and invest in far more profitable operations in Africa, where they
have they given us any indication where the money is going to go?
Yeah, we know it's going to go up into Africa. I mean, we don't know exactly which projects it's going to go on to, but I mean, they've already highlighted that they see opportunities in Africa, with margins of around 20%. And I mean, that just makes economic sense to go and take your money and put it where it's going to perform best.
I see Stephen Kossev is full of energy and very positive, and even restructuring the business. He thinks better times are to come. If we look at the Investec price today, is it worth buying?
I mean, Investec is one of our preferred banks. I mean, it's been a massive outperformer this year. I think if you look at the banking index, it's only up about 21%, whereas Investec is plus 40%. I mean, we went through the results yesterday. I mean, obviously they did get hit a little bit, just obviously because of the currency movement, because they're very sensitive to the pound rand exchange rate. But I mean, looking at their local operations, I think they're doing very, very well. I mean, if you look at across their specialist banking, wealth and investment, and asset management, I mean, all very, very nice growth figures in there, very nice revenue numbers. And I mean, it's a company that's going from strength to strength, especially with them wrapping up and divesting from a couple of operations in the UK and Australia.
Times Media, I see this morning that the share price just went right through the roof. Yeah. Who's buying?
I don't. Again, we have an anonymous market, but I can tell you it was on one share as well. So, I mean, it is quite an illiquid company. It's been trading at about 19 rand. It's probably its volume-weighted average price over the last 30 days. And the bid sitting there is still at 19 rand. But the double is so wide, the spread between the bid and the offer on that stock, because it's such a low liquidity stock that someone's taken one share and knocked it up 16% today. But I wouldn't take that as reason to go and buy Times Media. I mean, they did put out a cautionary, but with I think the total shares when I left the office were about 2,400 shares traded for the day. I wouldn't take that price action as indicative of anything to come.
I thought someone is coming in to take over the company. Okay, the last one I want to ask you about is Woolies. Okay, I'm sure when we go forward, we're going to see a few headwinds because everything has to be put into place and synergized and all of that. But so far, so good.
So far, so good. I think, in the numbers yesterday, I mean, you really saw the impact of that David Jones acquisition. So obviously they bought the Australian retailer, and I mean their revenue up, I think, was 47%. So I mean, enormous impact from that acquisition. Once you strip that out, I mean their numbers looked okay. They weren't fantastic. I mean, if you look at it, their clothing business was perhaps a little bit of an underperformer. I think their food sales revenue went at least growth went negative for the first time in probably 10 years. So struggling a little bit in South Africa, but I mean, Woolies again, it's one of our preferred counters. We're sure this one's going to bounce back. It's probably one of the only companies that gives, at least one of the South African retailers, that gives the public an opportunity to invest in a pan Southern Hemisphere operation. You just don't get that with any of the other retailers. So we still think it's a very attractive proposition for.
I'm not surprised Woolies is actually struggling with food sales in South Africa, seeing the price inflation they've had recently. Thanks for your time.